Now, before we get into this, again, we'd like to remind you, like, share, subscribe, but also if you have any questions, because we're going to go through a lot of data, I'm going to try to do it as quickly as possible just because there's a lot of slides and there's a lot that I'd like to get across, but I obviously don't want to bore you because it can, I find this stuff really interesting, but some of you may not. So I'll try to speed it up just to kind of hit on some of the important sides. But this is, I think, a good place to start because you can see that the economic surprises have gone negative, which just means that we're seeing that miss to estimates, which is what we keep talking about, where there's a lot of this froth in the market and excitement, and it's just not coming through, the economic data. And then when we look at a hard data, which I think is also a good identifier of problems, you can see that things continue to get worse and weaken on just where the surprises are. Like, we're not surprising to the upside, we're surprising to the downside, and a much bigger, piece of just what that surprise is and what that damage is going to be to some of the estimates and expectations for Q3 and into Q4. Now, when we just do a quick summary of key components, we'll look at, let's look at CPI. So CPI is very high, continues to be elevated versus going back through 2015. Personal consumption expenditure core price, again, still elevated, starting to roll over a bit, and not roll over in the sense where it's coming down, but again, just flatlining. And this is what we continue to see, where you're getting replacement in prices, where used cars are going to come down a bit. You're going to have some moderation in durable good prices, but then you have services, you have mortgage, you have rents. All of those things are, again, adjusting, where the Federal Reserve Cleveland median CPI still at 2.21% and going higher based on where things are going. And then the US CPI urban consumer less food and energy, which is the purple, again, 4.7. And then the Dallas Fed trimmed mean 1 year is starting to turn up, but is at 1.95%. So when you think about what the Fed has said of an average of 2%, you're getting an idea of, well, I can use any metric to get to, I just look at Dallas CPI. Dallas trimmed CPI is under 2%, so we can continue to ease. It's like, well, you have to take them all into consideration because they're looking at different things. And eventually, some of the pieces that are in one, when we look at sticky versus not, you start to see how you can get this pivot and how inflation can really remain in the system in different capacity. And you don't need to see inflation, these numbers don't have to keep climbing higher, but there's a lot of reasons why they can stay where they are and moderate or gyrate within the levels that they're currently sitting in. So then when we look at just across a swath of capacity, you look at commodities, which has obviously gone up, same with furniture, appliances. Now, appliances, I can say with confidence that if you were to buy an appliance today or building a house, it's 9 months. And that's a big problem when you think of, if I want something today, I'm either going to have to take what's in stock. And if I have to wait for that to come, they're saying it, 6, 9 months. So then when you look at tools, when you look at all of these different pieces, so new cars and trucks is going to moderate a bit, but only a bit, because you're starting to see some of the shifts in terms of pricing, age is there. If my buddy actually just leased a new car and he wanted to get a specific one, there was one on the lot. Now, mind you, this is one of the top selling cars and there was one available. And if he didn't want that one, they were saying 6 weeks. So you still have that problem in demand where the supply has not caught up with demand yet. We talked about that in Germany. We continue to have that in the US. And that's continuing on the new side. Then on the used car side, something similar, because again, one is driving the other. But then toys is interesting, because when you look at toys, you can see that hasn't been inflation in toys in a very long time, and you're starting to get that into the system, and it's because the toys are getting more complex. I'm at a point now. I have 3 girls, and my youngest is 2. And everything has a microchip. Everything moves, talks, walks, giggles, whatever, cries, grows, all of these different things. And it's because they're getting more complex, and the things that are using to make them we've essentially tapped out some of this capacity. Now look at plastics, look at microchips, look at wires, look at shipping, all of these components. So things that we're so used to being cheap may no longer be as cheap as they were. Now, I'm not saying that, I mean, I can go out there and buy a dollar that's $5. So $5 to $5.50 is not, a meaningful jump if you think about the price of a dollar. But 50 cents on something that has gone from 15 to 5, now going from 5 to 5.50 is important. And I had an interesting conversation with my father-in-law this past weekend when we were up in visiting for a wedding. I think it's just to create, just think about this realistically. If you go from, so say for an example, some of these prices were always at $300. So you go from $300 to $1,000. And you're like, all right, you're at 1,000. Then you go from 1,000 to 700, where you're like, oh, well, I fell 30%. It's like, right, but zoom out. When you zoom out, where did you start from? So then take it from the other side. So, when you look at when, prices fell from 1,000 to 700 is 30%. But from 700 to 1,000 is not 30%. So there's, when you look at percentages, it's very easy to get lost in them. And it's just important to understand where things are when we're looking at flow versus stock versus percentages, because we want to be very consistent in the language that we use. So then when we look at, just touching on this automotive side, the survey was for 1510, but it came in at 1475. So you're coming back into a bit more normal sales side. But again, there's sales have also slowed because prices are so high, consumers are balking. And they're like, look, I'm going to wait for your supply chain to catch up. But when you look at the average car, the average truck is 11.1 years old and the average sedan is 13. So there's only so long you can wait before you're tapped in and you have to get it, because if those cars break, good luck trying to get the replacement parts. So then when we look at comparing this against wages, so let's look at CPI, 2-year percent change. So you can see that the CPI is now drifting back up. We're over that 5%. Wages and salaries, the 2-year percent change. So when you look at the percent change, we have yet to get to where we were when you go back to 11 to 19. So when you consider the wage growth, it's happening in pockets. We're going to go through this in more depth, but you're not really getting the surge that we really need, or that can really capture or cover just how aggressive CPI has gone. Now, also think about how CPI is calculated with consumer prices. Well, if I'm hiring people at higher prices, I have to increase my price to cover the additional cost. And this is where you get this conflict with, well, how much can I hire, how many people, and at what price, given where I'm charging? So but there's more movement in specific locations, with a lot of the wage increases being at the lowest level, especially when you look at hospitality and bars and restaurants. So, but at the same time, again, you may get a higher wage, but it's going to prices, and it's going to rent in particular. So per Real Page data, apartment rents surged up 14.6% year over year in June, the most on record, with the occupancy reaching 96.5%, matching prior high in 2000. And then this is just showing the occupied rental units increase in the second quarter by the biggest annual rate in history. As people move back, you started to get into some of this normalcy, but you were now it's, are we going to get a moratorium on rent, or are we going to have to pay rent? You keep getting some of these fluctuations, and that's going to be, I think, the next driver of some of the pressures, where the numbers are going to get higher because the landlords are going to expect to get paid. So that's when we turn to the eviction moratorium. So the eviction moratorium is where the CPI, primary owner's equivalent, which is that 42% of core CPI, is flatlined. But when you look at the model, when you look at housing prices, landlord asking rents, vacancy rates, which are at multi-decade lows, rents are going to go up, and that's going to drain not only some of this excess savings that we keep hearing so much about, and I'm going to talk about that ad nauseum, but it's also going to take some of that money that was coming into for wages. Instead of it going to new consumption, it's just going to go to trying to cover living expense. So then when we look at the Americans' assessment of coronavirus, here's where you can see the increase in Delta variant has gone up. So getting a lot better has gone from 89% to 45%, and getting a lot worse, or a lot or little worse, went from 3% to 45%. So you can see the shift in terms of people getting a little bit more concerned. Again, this is not going to create this huge action on a federal level, but it's just showing that you're getting people that are saying, look, I'm going to take a pause. You know, maybe I was going to drive here, I was going to drive there. I'm just going to calm down a bit and let things flesh out a bit before I go crazy and start moving around a lot. So now let's look at savings, because savings in a nutshell is always something that everyone likes to talk about. But before we get into that piece, we want to look at travel, because as we talked about people things getting better, getting worse. And the reason why I talk about this, because people are also willing to take a hit to salaries. When you look at employee preferences imply a dramatic reduction in post-COVID office presence. So 30.5% want to desire amount of paid work from home days, 5 days per week. So 31% of people want to work from home permanently. But when you look at 2 days per week, 3 days per week, you're at about 30%. So about 30% want flex schedule, and 31% want full-time. So about 61% of the people that have come forward want either work from home full-time or flex schedule. This again is going to impact weekday travel. So when you consider what that means for mobility, for movement, for action, that again is going to eat into what the future looks like when we look at flex schedule. Even though you do have more people that have moved from urban to suburban to rural, those are the individuals that were already driving to work, or, you know, this is just going to limit or reduce the amount of driving that will happen on an aggregate at weekday level. But what are they willing to take in acceptance? So most people surveyed said they would accept a 5% salary reduction to be able to stay in a job that lets them work from home. So when you look at, when you look at millennials, it was pretty much across the board at 60% said that they would accept a 5% reduction, but they would not accept a 25% reduction. So when you look at what people are willing to do, they're essentially willing to give up the cost of travel to work from home and have that work-life balance. So I think that that's a fair ask when you consider what this is going to look like going forward. But now we get into some of the ADP numbers and what we continue to talk about. When we look at home base, compared to June, the number of employees working decreased in July by 0.4%. So we actually had a decline in employment from June to July. Now, remember, we're waiting for July figures. ADP just came out, and we'll talk about that in a minute. But this is just looking at when you look at businesses open, you have more businesses closing when you look at year over year, month over month. So you have more businesses closing and hours worked are rolling over. Employees working is rolling over. And this is a mixture of two things. It's one, some companies that are like, I can't survive in this current environment. I'm going to have to shut down. You have some furloughs as some supply chains are so stressed they have to cut runs on the assembly line. But also you have just the amount of people working that are just coming down because businesses are shutting. So then when you look at active job searches, you did get a small increase in active job searches. So what does this mean? It means that you could get a small increase in unemployment rate because you have people that identify as active, but you may get some worse numbers because they're also unemployed. So this is the active job search has increased since June. When you look at as passively searching, it went from 44.8% to 40.1%, and they have gone to actively looking urgent, has gone from 10.3% to 14.1%. So essentially going from passive to active and urgent. Now, ADP has been a kind of a poor gauge on where things were, but it's usually good on trend. So the trend is going to be that July is going to be a bit weaker, so much weaker than expected July payrolls, 330,000 versus the expected 683,000. and 680,000 in the prior month. So large companies were up 106,000, mid-size 132, small 91, small being the biggest issue in general. But then when you look at the service sector, again, the biggest driver at 318,000, but goods was only 12,000, information only sector lost 1,000. And then leisure hospitality within that service sector was up the strongest at 139,000. So what you would expect it to be, but again, just based on the leading indicators that we talked about, some of the employment, some of the assembly lines, some of the regional Fed PMI data is really showing that this is the likely trend where we're going to miss that estimate and see some of those problems going forward. But what have we been doing in regards? We've been stimulating blindly. So fiscal and monetary response to COVID has been massive. This just shows you the amount that has been dispersed, and what has been committed. So when you look at what has been dispersed right now, we've had about, and this is looking at legislative and federal actions. This isn't looking at just what the Fed has done, or on top of that. So when you look, we're at about $8 trillion with more to come. We're up to about 10 trillion right now. So you're going to continue to see that move into the system, which again has really driven those asset prices and has continued to keep this pressure moving in the system. But let's look at government stimulus has led to ample post-pandemic savings. Now, remember, this is where we sit today. As of right now, or as of May of 2021, this is what remains. You have to look at where we were, and we've seen some of this get drawn down and pushed into the system. But remember, it's not even. Over 80% of, over 72% of savings is leveled towards the top 20% of the U.S. economy, of the U.S. Income quintile. So when you look at that backdrop, you're seeing most of that is at the top tier, with 1/3 of it going to the top 1%. So yes, there is COVID savings that remains in there, but it is not in the lower 70% hands. And the same can be said going through, where you've seen something similar as wages come under pressure, more so in the euro area than anywhere else. So the remaining savings that is there for the people that need it most is going to get bled through, or going to get drawn down very quickly. So this is why when you look at what that has been built up, it's looking at the excess savings. So what is above what is normal? And it's just a lot of that is being accumulated at the top quintile, which again is leading to some of these pressure points when you look at who is going to get hit on discretionary spending and how is that going to adjust. Now, when you look at services, because you can go to concerts again, you can start getting back to some normalcy, some restaurants, those prices have exploded. So yes, you have that spare capacity, so you can cover that cost. Or you may not even bat an eye at it. But as some of that gets whittled down, you're going to see some of that adjustment. And again, this is not just a U.S. thing in terms of global U.S. excess savings, because it's saying it's at $5 trillion, but where does it sit, and how are they going to be doing something that is different versus what has been saved up for? And this is just showing that personal savings. So when you see some of this normalcy, so personal savings in billions. So we were as high as 6 trillion, and now we're back down to about 1.7 trillion. So then when you look at the U.S. personal savings as a percent of disposable personal income, we're at 9.4%. We're still above pre-pandemic, but you can see how quickly that has moderated back down when you look at personal savings as a percentage of disposable income, because it's starting to moderate. Now, the pace will slow down, but it's also a matter of where is it located. It is still weighted towards the top end, and those people were already spending. They were the ones that were driving the pent-up demand, which is what we were saying is the pent-up demand is still going to be at the top quintile, and you're not going to see it bleed through. And that's some of the pressures that we continue to see on spending, because the lower end, the lower 70% of Americans are seeing their everyday price. I mean, everyone's seeing their everyday prices go up, but it becomes meaningful the lower your disposable personal income gets and the lower your personal savings rate is. And again, those are things that are going to impact some of that longer term consumption. even though government transfer payments as a percentage of personal income still remains elevated. So government transfer payments still account for 19% of personal income as of June, but it's a sharp drop from the peak of 33% in March, but still higher than at any other point prior to the pandemic. So you still have some of this benefit. So the front end, when you look at April and May, you still had some of that residual stimulus. That has now come down, which again is going to continue. It'll level off because now you have some residual coming through, which we're going to talk about in a minute. So then when you look at the child care tax credit, so households that receive that tax credit, you see the spending, but it's obviously come down quickly. But households that didn't, you're starting to see some of that normalcy. You're coming back to the like when you factor in the distribution of the tax credit, you're starting to see some of the moderation where people are spending it because they need it, and then it's going away quickly. Now the safety net gives way. So the houses that received the unemployment benefits and houses that did not, you can see the moderation, but these spikes aren't as high. And it's because the level of stimulus has come down, but also the cost has gone up. So $1 you received in stimulus in April or April of 2020 is not the same dollar you got in April of 2021. And the same can be said about your dollar you received in June versus the dollar you received in June 2021. It doesn't go as far. So you're seeing that impact, you're seeing that process. So even though the savings looks okay, it's not going to go as far as if that savings rate was back in 2020 because the dollar has been depreciated to such a point that the buying power has been diminished, especially when you look at everyday looks. So then when you back it out, so take out support. So real personal income, and then real personal income less government transfers, you can see that we're not seeing that personal income growth without the transfers. We're not seeing that those wages really start to ramp up. And then the revised data continues to get worse when you look at just where things sit on the real personal income, excluding current transfer receipts. Again, you saw the recovery, you saw the bounce because you did see some benefits, you did see some job recovery, some wage increases, but again, you're not seeing the same level of income rallying up. So now when we look at some of the summaries, so when we look at just where some of the things are, U.S. manufacturing PMI coming in right in line, but construction spending down. ISM manufacturing missed from 61 to 59.5. Prices paid moderated a bit from 89 to 85.7. New orders are flat. ISM employment picking up a small amount for July from 51.7 to 52.9. Factory orders picking up, but again, when you look at backlog, also accelerating because the orders are picking up, but you're not able to meet them, which is when you look at durable order goods, coming in right in line. But when we shift to the market services PMI, came in right in line. ISM Services Index, but what is driving it? So let's look at ISM Services Index because this is the one that we were expecting to be a big beat, came in nicely, but what drove it? So service PMI at its highest level since 1997. Business activity rose to 67 from 60.4. New orders rose to 63.7. Employment picked up from 49.3 to 53.8, which we've been saying, but supplier deliveries rose to 72 versus 68.5. Inventories fell to 49.2 versus 49.9. Prices paid rose to 82.3 versus 79.5, highest since September of 2005. Backlog of orders fell to 63.5, again, slowing down. New export orders rose to 65.8 versus 50.7, so you started to get a big pickup. And imports fell to 51.6 versus 58.2, which means that exports going forward, you're going to start to see some of those adjustments. So that's a mixed bag. And when you break it down, you can see that there's some that are some really positive pieces and some that are a bit negative, but we need to go through those in different areas. So the service business activity index, when you look at manufacturing output versus the services, this is where we saw some of that moderation. On the price front, cost burdens increased at a substantial pace in July. Input prices rose due to supplier shortages, while service firms also highlighted greater fuel costs. fuel costs. That's another one that continues to come to the service side. The rate of inflation was much quicker than the series average, despite easing further from May's historic peak. So again, still rising, but just not at the same rate as May. So again, getting into that kind of flat line at these levels. So then when we look, output charges rose markedly, but in a similar manner to input prices, the rate of increase softened. So still rising, but not as much. Expectations regarding the outlook for output over the coming 12 months remain strong. Optimism was largely attributed to hopes of further boost to demand following an increase in customer numbers as COVID-19 restrictions relaxed. The concern is now with some of the Delta variant, so you'll see that moderate. And then the degree of confidence dropped to a 5-month low, however, amid concerns about the strength of customer demand over the coming months. So people are starting to get a bit more concerned with COVID and Delta and people just pulling back a bit, but we keep showing you wages and income because there's also an economic reason to see some of this not normalcy as well and some of these slowdowns. So then when you look at U.S. GDP price index, coming at a whopping 6%, again, just showing you just how aggressive that cost was in Q2. And this is when we start looking at some of those highlights, because when you look at goods, the backdrop. Now, remember, nominal growth was at 13%. But then when you look at real growth was at 6.4%, which was a huge miss. And it's just a matter of this moderation when you look at how much of that inflation comes out. So as consumer spending whittles down and consumer spending moderates to a point, imports remain elevated. Fixed investment is going to stay fairly flat, but we'll talk about that in a minute. It's the consumer and the government that are going to start to soften, that are going to become a bigger overhang to that recovery. So then when you look at the miss, Q2 GDP expanded at 6.5% versus an estimate of 8.5%. And 6.4% in the prior quarter. So here's where you can see just where things sit, how we've kind of flatlined, and now we expect to see a little bit of a rolling over and what drove that. So when you look at consumer spending, that remains the biggest driver. Business investment was there. That's going to come down a bit. We'll talk about that in a minute. Net exports are going to weaken. That has gotten worse since then, speaking about July, as we look about what is Q3 going to be. And so the consumer, again, going to become that headwind as inventories continue to drain down. So when we look at real consumption versus the trend, services are still not at pre-pandemic trends, but this is the convergence we keep talking about, where services will keep picking up as some of that the goods comes down. But it's just that we're starting to see some moderation in service spending as goods continue to fall. So on a net level, you're going to see some of these headwinds in terms of spending. But U.S. manufacturing orders still remain strong. But remember, orders are the concern because backlogs have grown and people are now putting in their orders because you have to put them in now for winter, for Black Friday. So again, you're starting to see guys move forward and try to get ahead of some of these supply chain issues. Where when you look at personal consumption, personal consumption continued to be a driver. But when you look at when you look at personal consumption chain dollars, it costs more to purchase. So it's a value versus volume. What is the volume you're able to purchase and so the value has gone up. And as we said in segment one, some areas have been able to capture a much higher price and push through some of that cost, but it's not really increasing the overall volume being moved through the system. So then when you look at PCE services, so PCE services spending has recovered pandemic losses. Goods consumption accomplished that last summer with personal savings level nearly back to pre-COVID trend. There's less fuel in terms of savings drawdown to keep the boost going. So that's why you're looking at this starting to moderate lower. And you can see that you had that nice little bump, and they essentially were inverse to each other. But now as they move away, you're going to see, again, that continue to drain down, speaking back to the issues that we keep talking about, even though personal consumption expenditures remain over trend, but we expect that to come back into trend. But when you look at the value of it in billions, you're starting to get that pushback on price, which again is going to cap the amount that people are willing to spend because there's some balking now on price, which again is going to slow down some of that demand, which will help moderate some of the, help some of the companies kind of rebuild some of their inventory, while you'll start to see this again act as a bit of a drag on the underlying economy as we go through Q3 and into Q4.